The big US banks have reported and the numbers are better than expected. The luxury goods market may have bottomed. Is LVMH a buy? I'm joined by Simon, who is going to try and convince me that the core and satellite approach is dead. What the? And we're going to close with a Pimp My Portfolio. We have our first guest in the studio, joined by Matt Ingram, where they have submitted their portfolio for Matt to have a look at to try and improve. Welcome to Equity Mates Investing, a podcast where we explore what is possible in the world of investing. My name is Bryce, and for the first time, I'm joined by Simon, my other equity buddy here at Equity Mates. Simon, how are you going?
I'm good. Great to be here, Bryce. You went solo earlier in the week.
I did, yes. Late last week.
Late last week. Now I've been called in. Feels like we've hit crisis mode, mate.
No crisis mode, but you're right. Ren is still on holidays. The show continues, though. The excitement levels don't drop. We have a massive episode today. Before we jump into it, though, Simo, we are in the final week of 2 job openings here at Equity Mates, one of which is actually going to be working alongside you.
Yes. So we're recruiting for an operations executive role, really hands-on role. You'll be getting involved in everything across the business, really, but we're looking for someone who's very process orientated, good commercial acumen, keen to help us develop with AI and how we optimize our processes and improve what we're doing here. So a pretty broad role, pretty exciting role. Check it out if you're interested.
Absolutely. And then the second role is a campaign manager to help us in our commercial team. So head to equitymates.com/careers to find out more information about those roles and to sign up. But let's get into today's episode. News and markets. Alrighty, well, the news that we're going to cover today, as we said at the top, the big banks over in the US keep on rolling. And has the luxury goods market bottomed? Simo, we're going to start with you. The story that has come across your desk is around the big US banks.
Yes. I think you'd be happy with this one, Bryce, because I know you're a fan of the Banks ETF, which covers the big global bank players around the world.
Ex-Australia.
Yes. That's very important.
It is very important.
But yeah, the big US banks here, so we're talking Goldman Sachs, JP Morgan, Citigroup, Wells Fargo, they've all reported this end of last week. Very strong results. They've really called out a rebound in deal making. So, IPOs or private deals happening behind the scenes, booming equity markets, and also this improving regulatory backdrop in the US is all helping with their outlooks moving forward. For
those who have been listening over the last few weeks, I did do a deep dive on the ETF, and what you've just said there was part of the thesis that it is sort of the time to shine for a lot of the big US banks with all the deals going on, IPO market warming up. So those numbers are starting to come through. What are some of the numbers?
Yeah, so some pretty good numbers. They were all in double-digit growth. So JP Morgan net income increased 12% versus same quarter last year. Goldman, they're the most heavily geared towards investment banking and trading. Their net earnings rose 37% to $4.1 billion. Citi's net income increased 18% to $3.5 billion. And then there's BlackRock. They said their assets under management has now reached a record high. Can you guess how much?
I would guess around 10 trillion.
13.5 trillion.
13.5.
It's just hard to get your head around those numbers, really. And that's up 2 trillion in 12 months.
2 trillion.
it's pretty insane numbers.
That is insane. 2 trillion. So double-digit growth. The banks are back, and I guess that's flowing through to their share prices.
Over the year, it's up. I think the bank CTF's up 30% or something. It's had a good run. But I guess there was some tempered expectations in these results as well. Execs from all 3 of the banks actually sounded the alarm somewhat on investor exuberance. Jamie Dimon, he warned that some assets are entering bubble territory. Citi CFO Mark Manson, he said part of the markets are looking frothy and overvalued. And the Goldman CEO, David Solomon, he said something similar. He said, no question, there's a fair amount of investor exuberance. There's a bit of history of these guys.
There is a bit of history, particularly Jamie Dimon. I think we were talking about this. It's sort of like, I guess, expectation management. But time and time again, he comes out with headlines of doom and gloom. 2025, he said he's far more worried than others around potential market correction of up to 30%. The AI bubble he's spoken about. 2022, 23, he famously warned of an economic hurricane on the horizon. I remember that was all over the Wall Street Journal. He said markets were way too complacent about the recession risks in 2017. He said that we're seeing a lot of froth. In 2015, he said markets look bubbly and expect a lot of volatility. So like he does say this stuff a lot, but I guess, I mean, he's a very, very successful...
He's a shrewd operator. He's good at managing expectations. Yes. So I think they've had a bumper quarter, so he's just got to temper things a bit.
Yes.
So but I think
that's his job.
I guess there's a couple of other maybe indicators that maybe things are a little bit frothy.
Okay.
So Bank of America, they just released their survey, and that was a survey for fund managers, so portfolio fund managers, and 60% of those think global equities are now overvalued. So I guess 40% don't.
Yeah.
So it's like, but that is trending upwards, that 60%.
Okay.
But another sign things could get frothy. This is an interesting one. A company here, they are called Volatility Shares. They have just filed for 5x leveraged ETFs on single stocks.
So just to be clear here, the company is called Volatility Shares.
Yes.
Okay.
So there's 13 new 5x single stocks ETFs. So there's a few companies you'll know here: Amazon, Google, Tesla, and there's some crypto, Bitcoin. So just back to basics, 5 times leverage. If your share price goes up $1, you're going to make $5.
Yep.
But the flip side of that is, if these went down 20%, you'd actually be 100% wiped out.
You're wiped out. I cannot believe that they're filing for this. I do agree this is peak froth. As you said, 5 times A&D, 5 times Amazon, 5 times Bitcoin.
Yeah.
What is going on? What is going on? This is peak market. I also just find it hilarious that this thing is called Volatility.
They're not hiding.
They're not hiding, are they? Anyway, look, I think we can keep speaking about this forever. I think there's no doubt that there is a lot of headlines around peak froth, AI bubble, you name it. But as we say time and time again, get rid of the noise. Just keep dollar cost averaging your way through this, because there's no way that we're going to be able to time when this.
There's been so many times over the recent years where I've thought it's getting too frothy.
Yeah.
Maybe I should pull out some money.
Yeah.
And I'm so glad you just keep dollar cost averaging. And I guess that's the power, isn't it? Automate it. Get out of your own way. If you're in it for the long haul, it's interesting. Stay in touch with the news, but don't worry.
Exactly.
Just keep dollar cost averaging in.
Exactly. All right. Well, given that you're here, Mr. Beat Up as well, for those that have joined the show, Simon is Mr. Beat Up. A stock that you'd spoken about on the show, LVMH, has caught my attention because for the first time in a number of quarters, it's actually posted 1% revenue growth. Now, 1% doesn't sound like a lot, does it? But to give you an idea of how depressed the luxury goods market is and how much of a turnaround or like how the market has responded to this, the 1% revenue growth for Q3 resulted in LVMH shares jumping 14%.
Yeah, wow. Yeah, I think it's just a sign that a lot of the view on luxury, I guess, is it broken or is it cyclical?
Yeah.
And I think now this has shown that the weakness is cyclical by, just the macro headwinds and pullback in key geographies, which has driven it, rather than a like permanent structural collapse of luxury. Yeah. So I think people have been waiting for this news and it's just popped back up. But I guess just to give it some context, we talked about this in November last year, 2024. The recording price then was $584. The recording price now is $597. So it's like, it's gone nowhere really for the last few months. It's just bobbled along. So I think it's like 2% up since we talked about it. So it's bobbled along. Probably you wouldn't get too excited, but I think it does help give confidence that this is more of a cyclical thing than a luxury's busted.
Yeah, luxury's definitely not busted. Some of the drivers that have seen, I guess this sort of we're not going to say turnaround, but like some positive news for LVMH. China's comeback, demand from the Chinese consumer has turned positive for Q3, which is the first time this year. Asia outside of Japan has showed noticeable improvement due to travel rebound and a lot of local shoppers returning. And creative retail experiments. I don't know if you've seen Louis Vuitton's massive ship-shaped store in Shanghai. It's incredible.
Ship-shaped?
It's shaped like a ship.
What type of ship?
Like kind of like a big icebreaker.
Oh,
yeah,
like Titanic.
It's massive. Yeah, check it out. Have a look. Drawing a lot of crowds. And so anyway, the consumer seems to be back and everyone is now keeping their eye on this turnaround. Could be an opportunity to revisit LVMH and the Mr. Beat Up segment that we did, because these guys are certainly well placed at the top of that industry. So should anyone benefit, you would think it'd be these guys.
And I think the big thesis, I guess, on LVMH is this ongoing trend of income inequality and wealth disparity in the world. Like, and there's no signs at the moment that that's going to change. You know, the rich are getting richer.
Yeah.
And what are they going to spend their money on? Like, I think one of the big trends is more tourism, and like luxury tourism is definitely growing. But these luxury brands, they're going to find a way. Like, you know, LVMH, they own, I think, around 75 different brands. They're starting to move into luxury tourism. They'll find the luxury space, and they're going to be there ready to service it. So I think as a bottom drawer stock, it's probably one you could buy, sit on for years, come back and be quite happy with some half decent.
General advice only.
General advice.
But that is true. Well, to keep up with all of the news headlines, make sure you subscribe to our daily newsletter. We'll send you a dot point summary of all of the important headlines moving markets and our portfolios every morning, 6 a.m. We also turn those dot points into a podcast every morning if you would prefer to listen to it. It's called Headlines by Equity Mates. Make sure you subscribe to that as well. Is the core and satellite portfolio dead? We've been doing a lot of content recently on how to set up the perfect core portfolio and accompany it with your satellite. But Simon is here to challenge the idea that the core and satellite is the way to go. Simo, I was surprised when you wanted to talk about this, because we have done a lot of content on core and satellite, but you've been thinking quite deeply about your portfolio.
Yes.
And I think a lot of this stems from the new segment that we've been doing, X Marks the Stock, where we look at stocks that have got a lot of buzz on Twitter, or I should say X, and you've said that it's changed the way that you're thinking about investing.
Yes, it has. Yeah, it has.
i.e. FOMO.
Yeah, I think it's just made me realize I'm too restricted.
Okay.
And some of these stocks have absolutely ripped. Iron's the one we keep talking about, 160% in a month. But the way I've structured my portfolio, I've actually been watching from the sidelines. I've missed out on that. And it's made me rethink the whole core and satellite approach. I feel like it just needs to update. So I want to workshop an idea with you. I also just feel the analogy is pretty rubbish. Like, it doesn't really appear outside finance, you know.
No, it doesn't.
Like, you don't hear your personal trainer talk about a core and satellite fitness plan, or
but you do have like foundational lifts and then auxiliary lifts. You know what I mean?
Is that the language?
Yeah. Well, I don't know. Like the core, you do have like your core lifts. You have squats. You have bench. You have. Do you know what I mean?
The concept is right. If you're in the investment world, it totally makes sense. But I think someone coming externally, like core and satellite, just doesn't, like, what are we talking here? We're not building a space program. Like, what? And if you actually think about it literally, satellites orbit around a central core.
Yeah.
But in portfolios, the satellites, it's nothing to do with the core. It just sits separate. There's no gravitational pull between the core ETFs and your satellite.
Well, the counter argument is that the core is the foundation and the bedrock that allows you to go out and shoot satellites into space and hope that they zoom around and beat what you're doing in your core.
Okay. All right. We've got some work to do.
Sun and satellite then.
Sun and satellite,
Earth and satellites. Anyway, so how has it changed for you then?
Well, I just think we need a better analogy, and I need a new version that actually reflects how I want to invest.
Okay.
So I've come up with what I've called at the moment, work in progress.
Okay.
Body, mind, and soul approach.
Okay.
All right.
Talk to me more.
Okay. So body is your foundation. Okay. You need your exercise, you need your diet, you need good sleep. This is the stuff that keeps you healthy long term.
Yeah.
So investing terms, there's 3 things we really look for, like diversification. So that's your exercise. You need cardio, you need resistance training, you need a stretch, you need variation. Low cost fees, that's your diet, okay? You don't want to get too fat on the calories. You got to keep the costs down.
It's one thing you can control.
It's one thing you can control.
Yeah.
And then Index tracking, I'm trying to align this to sleep. Maybe doesn't work quite as well, but you got to get your 8 hours each night, right?
Yeah.
To get a normal return out of your day, you got to get that 8 hours per night. So investing terms, that's your low cost, diversified index tracking ETFs, nothing flashy, just solid, consistent performance keeps you healthy.
Sure.
So that's
Okay. That's that.
pretty similar to core, just a better analogy.
Well, I mean, you've just redone what it relates to. Yes, you've given it a completely different analogy, but the concept is the same.
Yeah.
Okay.
Then comes the mind, right?
Okay.
This is where you start to use your brain
Okay.
or the brains of others.
Okay.
So this is where you try and beat the market, get alpha.
Yeah.
It's where you stay curious, engaged. It might mean picking individual stocks or backing an active manager or thematic, stuff you spend time on.
Yeah.
Take decent positions in, backed with a solid thesis.
Okay. So let's just be specific here. You're talking, this is where you would go out and put small cap managers.
Yes.
This is where you would go out and put a cybersecurity thematic ETF.
Yes, you
This
know
is where
my
you would-
portfolio.
This is where you would go out and put Tesla.
Yes.
Okay. So far, all you've done is renamed your core and your satellite.
Pretty much.
How does that go right back to the start where you feel like you've been restrained then? You want to release the shackles.
So this is soul. So this is where it gets personal. This is the personality in the portfolio, okay?
Okay.
This is individualized. It's your risk appetite, your values, your curiosity. For me, deep down, I'm a bit of a gambler.
Yeah.
Okay? I need space for that.
Okay.
I need chance to go into high volatility, high upside. Keep
You need
it
to go
fun.
into the 5 times leveraged volatility shares.
Yeah, exactly. But for someone else, it might be ethical investing or backing causes they believe in. But I think for me, this is one part of the portfolio. It doesn't have to justify itself with returns. It just has to feel like you.
Okay. And so just to be clear then, the reason that you have sat on the sidelines and not gone into stocks that you've always, I guess, at the end of the day, just wanted to have a bit of a punt on and just have that bit of excitement is because you felt that you didn't want it to mess up your satellite approach.
Exactly. And I've got too many satellite positions at the moment. So I'm trying to get more, 3 to 5% in each holding, concentrated, so they actually make an impact if they do well.
Yeah.
But I've done time on these stocks, so that makes sense too. Like, if I'm buying them, I've got to believe in them.
Yeah.
Don't just take small little bets.
Yeah.
Whereas something like iron, it's like, I'm not sure, but the momentum's there and the thesis seems right at the moment, but I might need to trade out of this in a month's time. But at the moment, it's like the way I've set it up, my portfolio is not designed to do that. So
Okay.
I need some cash there to be able to,
So I understand that all. How are you then actually setting this up? Like put some numbers to it if you can.
Yeah, so for me, I'm thinking roughly 50% body.
Sure.
Just like half of it in the core,
Yeah.
set and forget, DCA, don't check it very often, just be set up. I'm probably then thinking 40% in satellite. Now, this might be lower for other people, but...
In mind.
Sorry. I've caught myself.
Busted.
I'm then thinking 40% in mind. But this may be higher than other people, but I work at Equity Mates, so we're talking about stocks all the time.
Yeah.
Like I'm meeting active managers, like I feel like I want to put a bit more in there. Other people that might be a lower percentage. And then probably 10% in the soul. So it's like not a crazy amount, but it's enough also to have a bit of capital to play with.
Effectively what you're saying is we come on and do segments like X Marks the Stock, Mr. Beat Up, where, we talk about LVMH, we talk about Nike, we talk about Boeing, we talk about Supermicro, all companies that have done Apple, that have done well post doing the work on that. We then do X Marks the Stocks, Duolingo, you name it, these companies are ripping. How are you going to distinguish between what goes into your mind and what is just this punt?
It's soul, not pun.
Oh, sorry, it's soul.
I think for me, it's like I'm going to have a separate account, first of all, just have a separate account for soul, and I'll have like the funds in there to do that.
And you'll still be capital constrained.
I'll maybe if I put 10% in there, like or
every
whatever.
fortnight or whatever.
Yeah, I'll probably start with some initial capital, but then if I'm DCAing, X amount each month, 10% of that will go into that fund.
Okay. Yeah.
I think the difference for me is like, if I have a long-term thesis on a company or a thematic or an active manager, it goes into mind. Yeah. It's like, I want to get 3 to 5% in there. Like, I'm not messing around. Whereas other stuff where it's like, I've heard someone come on to the podcast who I really rate, but I probably haven't done enough research on the stock. But like at a top level, I think it makes sense, or it's aligned to what I want to invest in. I can have a dabble in that. That's okay. It's not going to ruin my long-term gains. It's giving yourself
permission to do it.
For me, it's giving me permission. But for other people, it might be permission to invest in other stuff, which they know they're probably not going to get the same returns on. But they can now have it in their portfolio. So, yeah, for me, it's the punter. But for other people, it might be a different.
Yeah. Look, I get it. I've been doing. I think all of us actually. We're going to do an update on our core portfolios in the coming weeks because we've been really thinking about restructuring a lot of what we're doing, and I do feel the same in terms of having the space and knowing that you just have a bit of cash to have a play with these things. It does feel to me, though, this is peak froth. This is peak froth. I mean, we just did a segment on froth. And I don't think we'd be talking about this if all of the stocks that we've spoken about on X Marks the Stock had plummeted 100%.
True.
It's just because we've seen iron rip 166% in a month.
Yeah. My counter to that would be that it's controlled exuberance. Okay, and it gets me more focused in the mind section with bigger bets, because at the moment that's where my soul's going to, and things are getting watered down, and I need to be more conviction in there, and then have this space to play around over here.
Conviction builds wealth, diversification protects it. I do agree with satellite positions. It's better to have a more concentrated portfolio. But love it. Look, mind, body, soul is the new approach for you. The fact that you're constantly reviewing this and thinking about how to improve it, I think is a good demonstration of what a lot of us should be doing as products come to market, like these geared ETFs, for example, that didn't exist even 12 months ago, and thinking about how that can be part of the portfolio, I think is really good.
Yeah.
Love it. Well, if you also, like Simon, think that core and satellite is dead and you have a different approach to setting up your portfolio, we would love to hear from you. Send us an idea of how you're setting up your portfolio to equitymates.com/contact, and make sure you join us next time Simon is on as we go through some of your soul positions, Simo. We'll also get you back for X Marks the Stock in a couple of weeks, and of course Mr. Beat Up as well. All plenty of good segments for some stock ideas for your portfolio. We're going to take a quick break, and on the other side we've got Pimp My Portfolio, where we are joined by Matt Ingram from North Haven Financial Solutions, and a guest in the studio who is going to show their portfolio for Matt to try and improve. We'll be right back. Okay, it is time for...
Pimp My Portfolio. Pimp My Portfolio.
That's right. This is a segment where we get a community member to submit their portfolio for one of our experts to review and provide some ideas on how it might be able to be improved. And for the first time ever, we actually have a community member here in the studio with us in person, which we're really excited about. But before we intro them, our expert today is Matt Ingram. Matt, welcome.
Thank you.
And today joining us in the studio is Will. Will, welcome.
Thank you. It's nice to be the first in person. It's a record I can keep.
Record. You
can't take that away from me.
Can't take that away. That is all right. All right. Well, as always, we've got Will's portfolio here that he's sent through. Ren, do you want to introduce what we've got?
Sure. So, Will, I'm going to hazard a guess that you're running a bit of a core and satellite portfolio.
Yep.
The core is, there's 3 main ETFs that make that up. So you've got VAS, the Vanguard Australian Shares Index ETF. Then VEU, Vanguard All World ex-US, and then the S&P 500 ETF, IVV. Together, those 3 are a scratch over 80% of the holdings.
Yep.
And then there's one more ETF, the VanEck International Quality ETF, QUAL, and then a few individual stocks, 5 to round it out. LaserBond, Macquarie, NextDC, ResMed, and Xero. Good Australian growth names there.
That's it.
Now, how we like to start this is we get our expert to characterize the portfolio or give it a nickname, and then we'll get into it. So, Matt?
I've called this one the planking portfolio because it's got a strong call.
Nice.
Okay.
Doesn't get much better than that.
When you first said planking, I thought you were referencing. Do you remember that social media trend from like 10 years ago? Where
the exercise, not the thing we all did when we were 15.
Well, I mean, you need a strong core for the thing we did when we were 15 anyway, don't you?
No, you just lay down. You lie down.
You just lie down on anything.
All right. So you like the core, strong core. So let's start with your feedback and maybe start with the structure and the core. What do you think of Will's portfolio?
Honestly, good job. This was the hardest one to provide feedback on that we've sort of looked at lately, just because it was pretty sound, pretty good. So
all right, and Will, that's the segment. Thanks for coming in.
Yeah. So Will, why don't you take us back and explain how you have thought about building this and what the process has been?
I started investing a long time ago and then had some bad experiences, went away from it. And then I came back and pretty much in time with your podcast and I got on board. So I do owe a lot to you guys for your podcast, for understanding everything and things like that. So start off like most people, bought a couple of individual positions, went from there. Then I sort of just started working out what I could handle and my sleep at night factor. So I sort of just then developed into the core and satellite thing. And then even in that, I'm thinking about moving away from the individual positions a little bit, just because I don't have to then keep an eye on them and do all the due diligence, I guess, on them. So just be lazy with it. Yeah, that's it. I've sort of, again, sold my weeds over the time and, watered the flowers type thing. Yeah, just trying. Again, I just listen to all the podcasts and just try and keep learning from other people's mistakes so I don't make too many, I guess.
Love that. I mean, can you talk us through how some of the individual stocks have come into the portfolio?
ResMed and Xero, I bought when that tech crash. So I got them really cheap. And then I actually have sold down on them because, again, I've had some other positions over the years that have gone really well and I've let them go and then they've gone to nothing and I was really scared of that. So I thought I'll take my profits off them and I feel like that's just play money now. Like whatever happens, happens. Obviously, I don't want it to go to nothing, but if it does, I haven't lost everything. And yeah, just Macquarie was a stable, sort of that fifth bank at the time. I didn't want to be in the big bank. I thought that was something a bit different. I like that. Probably Laser Bond's my biggest, it's my only one in the red at the moment, which is a good thing. But I just think that thing into America hasn't really paid off, but I haven't given up on it yet. But so.
Love it.
And then I sort of went to, I got my three big core ETFs and I was thinking about with that qual, boosting that up to make that almost trying to generate some alpha with that. And then I really wanted a small cap world ETF to round it out, but I haven't really found anything suitable. So that's where I was kind of heading with it, but.
Nice.
Well, those are a few questions I'm sure Matt can weigh in on. So why don't we start with qual, Matt? What do you think about that as an ETF and how would you think about that adding to the core?
Yeah, I think the core is good as it is. I'd made a note here that you probably don't really need qual.
Okay.
To generate a bit of alpha, but over time it hasn't done a whole lot more than just the broader world index. In some periods it's outperformed a little bit, but nothing that you can really count on. I think keeping it simple is probably most effective. You said there that you're thinking about ditching some of the direct names anyway. If you're just ditching direct names to add to more ETFs, then you're not really simplifying. Those three, that's the core that I would build for any client. I honestly really like it. Even the way you've weighted it, I think is great. It kind of resembles the broader world market in terms of weightings with a bit more of a focus on Australia, which makes sense because you live in Australia.
Yep.
You're probably going to retire in Australia. Your currency is in Australia. You're just keeping a bit more of it here with a home bias. Yeah, so I think that's appropriate. That's good. With the direct names as well, they're small holdings. They're not taking up a huge part of your portfolio, which is great. 3 to 5%, generally fine. In some cases, it's a bit lower, and that's fine as well. And that's things where you've taken a bit of a profit, like you said, Xero, and Laser Bond, where maybe it's just dropped a bit in value, or you're not really hedging your bets on it. You're not going all in, which is totally appropriate. So I think if you want to keep the satellites, they're all good names. Laser Bond, don't know too much about it. But Macquarie, ResMed, NextDC, Xero, all really good names. Yeah, you can keep them, you can dump them. Won't make too much of a difference, I think.
So what percentage does then my individual stocks become irrelevant? Does that make sense? So when they're not enough, no need to either add to them or sell them. At what sort of percentage?
As in, like, when will they get too big to sell them?
That'd be a good problem, but more the too small problem. I'm thinking, like, is it not adding any value to my, when it gets to a certain amount?
I find there's two reasons why people have satellite holdings in their portfolio. One is because they're genuinely trying to get a bit of alpha. They think they can pick stocks that are going to outperform the market. The other one is just fun. It's interesting and they like doing it. I think in either case, or maybe, if you're doing it because it's interesting and you just enjoy it, then you probably shouldn't be taking big bets, right? And if something is 1 or 2% of the portfolio, I don't think it really matters. If you have 1% holdings, well then it's getting a bit messy and it's probably overboard. But something sitting at 2 or 3% like you have here, if you're interested, you want to see how it plays out, you have a bit of conviction that it could do well over time, I would just sit on it. I wouldn't bother getting rid of it. If it's, failing and crashing and you lose conviction, then just dump it.
Yep.
But generally 2 or 3 up to 5%. When it starts getting a bit bigger than 5%, you kind of just need to weigh up the fact that that thing does halve, trimming a couple of percent off your what's meant to be outperformance from these things, and then they're going to start being a drag on the portfolios.
Okay.
One exercise you could do would be to sit down and work out how those group of individual stocks have performed versus your 80% odd core to see if you are actually generating alpha or if it's not. I mean, you might find that you're absolutely killing it.
I mean, looking at some of those names and thinking about when you bought them, I reckon you're probably outperforming your ETFs.
Yeah. Well, Zero, I think Zero's doubled.
There you go.
So,
So investing so easy.
My first couple weren't, trust me.
So, Matt, Will asked about small cap exposure. How, when you're building a portfolio for clients, how do you think about adding small caps?
Yeah, look, you've probably heard it a bunch of times on this podcast or elsewhere. Small cap active management can often pay off. You look at what small cap indices do, and then you look at a lot of small cap managers, and they can typically outperform. I guess there's just so many names there. There's a lot that aren't doing so well, and for a manager to come in and pick the ones that potentially are going to perform is often a good approach. So there's a few active ETFs for small caps. Small caps have been on a bit of a tear lately. They have done very well. I think adding some exposure to it makes sense. To backtrack, I said adding more ETFs probably doesn't make sense, but adding ETFs like Qual, where it's doing a similar thing to what you're doing already, I think there's probably not a whole lot of point in that. But something like a small cap ETF, whether you go down the more passive path of, like a Vanguard or whatever it is, kind of just passive ETF, or a more active one. So there's companies like Spheria, there's a bunch out there, do some Googling and come across some really good active ETFs. And then just having a smallish allocation to that.
One of the things I was worried about with the actives, and that's how I kind of want to go, but I've been scared off by the percentage fees.
Yeah.
When you guys talk about it all the time, and I'm like, okay, what difference does it make between, 0.04 basis points to what, that sort of thing? That worries me.
And if you're looking at a small cap manager and they did, they're getting 20%, or call it 15% a year, and the index has done 10% a year, but you have to pay them 0.5%.
I think the way that we think about it, particularly with small caps, is like you're actually paying for a skill set that has traditionally outperformed the index. Whereas if you're paying for a large cap Aussie fund manager, 1% versus the ASX 200, like you're really paying for something that they're going to just generate anyway.
Just make sure when you're looking at their performance, you're looking at after fees, and then you can sort of do a like-for-like comparison.
It's the one space I feel like the professionals, it's worth going active for sure.
Oh, there's a few emerging markets, small caps, fixed income, active seems to outperform. So there's there's a few areas. It's just this like super liquid large cap, Australia or the US. That's where active managers struggle to beat.
Now, just one other thing that we wanted to tackle before we finish up, Will, was a question around debt recycling that you had. Correct me if I'm wrong, but you're thinking about doing it, but unsure if you should be using the portfolio that you've already got or just contributing new capital to the mortgage.
Yeah, well, that's basically where my question lies, because my portfolio's done okay. So to take that big capital gains hit, am I really negating the benefits of what I'd get out of debt recycling, I guess, the savings?
Look, needless to say, of course, there's so many considerations in this. Generally, it makes sense. If you have a pretty large mortgage that you're going to be paying down for a long period of time. Getting rid of that non-deductible debt, it's a risk-free return that you're getting basically immediately. And that in itself is going to compound over time, right? The less interest, non-deductible interest you have to pay over time, the more that's going to compound. So don't see it necessarily as I'm giving this thing up to do this other thing. Like, you're getting a return in both cases, and then you're getting that portfolio back in some sense if you're going to debt recycle and reinvest and whatever it might be. So generally it makes sense, but it's going to come down to, what's the size of your mortgage? What are the capital gains here? A few simple calculations. You can model it out and see pretty quickly if that's going to make sense. In most cases, yeah. In some cases, no. I think in this case, we should have a chat after this.
Okay. Sounds good.
We'll leave you guys to chat small caps and debt recycling after this. But I think to wrap this up, well done. Bryce wrote down this quote as Matt was talking. Quote, "The core I would build for any client."
Huge.
So that's pretty high praise.
Yep,
so
like that.
Keep doing what you're doing, and you're gonna have the biggest pool on the block.
Yes.
Perfect.
Well, thank you so much, Will. And if you would like to submit to Pimp My Portfolio, just like Will did, head to equitymates.com/contact. If you'd also like to speak with Matt about your portfolio or any of your personal situations, then head to equitymates.com/advice. And there's a form that you can fill in, and we'll connect you with Matt. But Matt, thank you so much. As always, we really appreciate it. And a huge thank you, Will, for coming in.
Thanks for having me.
First in person. That was awesome.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.